Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, January 22nd, 2016. This week, stocks hit a awkward number of 92-week low, which translates it to about 23 months low, and finally got an oversold bounce on Wednesday. But I think the biggest trend is still down. Various economically sensitive funds hit multi-year lows this week. We'll also look at treasuries and some of the longer term charts, and they may be set for an all-time high rally. US dollar is approaching 52-week highs again due to comments from Draghi and Kuroda of the Japan Central Bank. Gold and GDX are sending mixed messages. Oil finally got a big bear market rally, and we'll look at possible bear wedge that is forming on the chart of natural gas. Right, so this is S&P 500 ETF SPY, kind of like a proxy for the market. So if you're a trend follower, one of the easier ways to figure out what the trend is to simply look at the moving averages, which is a red line, which is a 50-day moving average, and this green dotted line, which is a 200-day moving average. And basically, if the 50-day is below the 200-day, then the trend is down. And we had a couple of whipsaws here. Basically, we dropped down into bearish territory, then came back up. We had a bullish crossover, and now again we had a bearish crossover. So both bulls and bears got whipped around quite a bit. My private indicator market breadth index signaled that we're already in a bear market back here. So this rally was already a bear market rally in my book. Now we came down pretty hard and hit a this is S&P 500, which is ETF, which includes the dividends. And the next chart I'll show without the dividends, we actually hit a multi-year low, well, not multi-year, at 92-week low, which is almost a 2-year low. So with dividends, we have not yet hit, a 52-week low, but without them, of course, we did already. In any case, this bounce is really long overdue. I actually thought that this bounce will start around here. It clearly failed on 2 occasions. There was one attempt right there and another attempt right there. They both failed, and finally we got this long rejection candle on Wednesday. This is a if we closed below here, it would have been very bearish. But in any case, lots of panicked liquidation, and of course the bull stepped in then. I think this is a bear market rally, and I think it will eventually peter out somewhere either around this broken support or possibly higher. Even if we make another all-time high, I don't think it will change the picture just yet. I will need to look at some of my other charts that I follow, but the market breadth is still decidedly negative. So further down below here, we have on-balance volume, which is signaling already lower lows, even compared to this low. So we're already making lower lows in on-balance volume, and it's possible that it's going to lead the price lower. Advanced decline line and advanced decline volume line also made a lower low already. So all of this is pointing to lower prices ahead. You can even say that this could be a divergence because we already made a lower low here, but the index itself has not. Excuse me. Although on next chart I'll show that the underlying index, the S&P 500 itself, without the dividends, did make a lower low. So let's look at those next. Okay, this is a little bit of a longer chart. This is an 11-month chart. We made a 92-week low. Next chart I'll show you why that weird number. But in any case, the point of this exercise is that we actually closed below these two lows. So on Wednesday. So this is certainly not a encouraging sign. We did get an oversold bounce since then. Of course, we are clearly in the oversold territory, but again, in a bearish security, oversold conditions are the rule and not the exception. So yes, we are certainly oversold, like this price momentum oscillator, other oscillators. We are in an oversold territory, but again, in a bearish security, we don't look, or at least I don't look for oversold conditions. I look for overbought conditions and attempt to go short then. As far as market breadth, certainly we were on Wednesday at very least, in a quite oversold territory. Um, this is S&P 500 percentage of stocks above the 200-day moving average. So, we were somewhere around 25% here on Wednesday. Certainly, oversold territory. Same thing for bullish percent index. So we were on Wednesday in oversold territory. So the best thing I can say for the S&P 500 and for stocks by extension is that we are bearish, but we are oversold. So an oversold bounce we're basically in the middle of an oversold bounce. Where it will take it, most likely to this broken support around 2000 or so. Next step, of course, is around 2025, where the 200-day moving average is. Potentially, we can get as high as 2081 and maybe even in this area. But there's just so much resistance up here in this area here. All right. Next, let's look at the even longer-term chart of S&P 500. Okay, so this is S&P 500 weekly, going back to 2013, January of 2013, and this is a weekly. So each of those bars is one week of activity. You can see that here we had a spike low to, let me see where it was, 1812. We didn't close below the 1820, which is a last October, or the October 2014 low, or for that matter, below these lows as well, on a weekly basis. However, on a daily basis, we did close below these lows. Now, this is a 92-week low, also known as 23-month low, so I cannot say that this is a multi-year low. I can say that this is an almost multi-year low. So if we break below these lows here, that would be a multi-year low, and certainly not a good sign. If you just look at this pattern here, this could be like a big head and shoulders pattern. So that's a possibility. Let me do a quick measured move. Target for this head and shoulders pattern, and if this is indeed a head and shoulders, we can be looking at another 14% down. So around here to 1500 or so, 1600. That's a measured move target for just this pattern alone. We don't know exactly how long the bear market will continue. All I know for now is that we are in a bear market, and I'm looking only at short setups. Okay, next chart is that of New York Stock Exchange Composite Index. Very nice indicator here, which is a new highs, less new lows, divided by total active symbols on NYSE. One way to measure, if we're in a bull or bear market is to see if percentage of stocks on this indicator is above plus 5%, 0.05 or below 0.05, so a negative 0.05. So we actually hit a negative 0.05 here in, let me see where this is, in July of last year, and still continued, not been able to hit a plus 5 just yet. And you can see it makes sense because we've been making lower lows and lower highs, lower lows and lower highs. So this is basically a bear market looks like this. It looks like a series of lower lows and lower highs. Now I pointed out this pattern, which could be a inverted cup and handle pattern. Maybe if we rally here and sometime maybe here or maybe even at 10,300, we peter out, then it could be like a right shoulder, or maybe this is already a right shoulder right there. So if this is a head and shoulders or a cup and handle, so a conservative target would be 10% down, and we are only about 6.2% down if we go to this low, which is already a multi-year low, by the way. So for now, I don't think this pattern looks complete to me. Maybe we rebound and then make another low. And this is just this pattern. We will see if another pattern plays out later on. The other indicators are also confirming bearish posture, and that is on balanced volume, advanced decline issues, and advanced decline volume lines both hit new lows for the move. So that's also confirming the bearishness. Very few stocks were above their 200-day moving average. Back here, I even started to point this out. We closed below 40, and we're not even able to get above 50% of the stocks above their 200-day moving average. So quite bearish. We are oversold, as I mentioned. We are somewhat in a bearish territory, oversold, but again, as I said before, in a bearish security, we should be looking for overbought conditions to short them. Same goes for bullish percent index. Maybe we're somewhat oversold, but if we do rebound, that could be a nice short setup. Right, that's all I want to say about NYSE. Okay, next is IWM, Russell 2000 iShares. This is a more economically sensitive security. It's more volatile. Kind of similar pattern here, maybe a cup and handle, or maybe a head and shoulders pattern with a breakdown of the pattern. So this one actually did complete the head and shoulders, or whatever the inverse cup and handle is, about 10% move, and this is about 10% move to the downside. But these stocks, the Russell, small caps, are more volatile than the rest of the market. So maybe we get a rebound and another leg lower. Interesting thing that, like, I showed the S&P 500 where the moving average, the red line, actually came above the 200-day moving average. Here it didn't even come close. So this one remained significantly weaker than the rest of the market. Again, on balance, volume is pushing lower, and it confirms the bearish posture. Advanced decline lines, same thing. New lows and advanced decline lines this week as well. Some of the other economically sensitive sectors is XHB, home builders. I featured this chart last week as well. Broke down and continued lower to 52-week lows, and then rebounded this week with the rest of the market. Another one, which is emerging markets, of course, this is multi-year lows. I think it's like 7-year old or something, 7 old. Anyway, so also quite choppy trading here. Look at those. There's quite a bit of gaps here, up and down. But in any case, this is indicating that economically sensitive and high beta securities are certainly outperforming on the downside now. All right, next we'll go into bonds, and they look much better than stocks. All right, this is TLT, long treasuries fund. So I think we had a breakout here just last week above these peaks here and above the closing high here. So this week looks like we ran into resistance possibly from this peak here. But on the next few charts, I'll show a possibility of an interesting cup and handle pattern for TLT, and if that's true, we might see some significant upside. I think treasuries are bullish. They were kind of trading sideways more or less, but I think from a longer term perspective, I think treasuries are still bullish. Interesting indicator on balanced volume. You can see it was consistently pushing higher, even though the TLT itself was trading more or less sideways. We hit another a high for the move for the on balance volume. So that's certainly a bullish sign in my book. So next, let's look at a longer term picture in TLT, and we'll see where the targets are for the upside breakout should it occur. Okay, this is TLT, same chart, but going back to beginning of 2014, so it's 2 years worth of data, and this is a weekly chart. So each of those bars represent 1 week. So we're here right now, and it looks like a big rejection candle for now. But I think this could be like a cup and handle pattern, and if we do get a breakout above 127 and some change here with a close above it, especially on weekly basis, we could easily see at least this pattern, the height of this, the depth of this pattern repeated back on the upside. And this is a conservative target. We can actually see a height of this pattern as duplicated on the upside. So we do a quick measured move on that one. Oops. We can do a quick measured move on that one, and this height of this pattern is actually 12%. So, and that's, let me see how many, that's 14 points. So 127 plus 14, that's 141. So we could see TLT up here somewhere, especially if stocks come under further selling pressure. So just something to keep in mind. I think if you're not trying to short the general market, one of the better places to be, of course, would be in bonds. At the very least, they are not losing in value, and possibly they will appreciate. All right, let's next continue to the dollar. Okay, so US dollar index daily chart. Not much really have changed since last week. I think that we're basically kind of moving upwards in this kind of trend channel. These are 52-week highs here, back here, so we could easily challenge them. And with all the money printing, or at the very least a hint of money printing in Japan, Governor Kuroda said that they might start easing even more. European Central Bank said, kind of hinted at it as well. So certainly, if they print more euros or Japanese yen, then dollar will become more attractive. That's all I want to say about the dollar. Let's move on to the commodities part of the presentation, and gold is next. All right, this is gold spot price daily end of day time frame. So interesting thing, interesting chart. I really think it is. So here we had a breakdown in November, and I was certainly thinking that we're going to get a move way down to about 1,000. Just based on this height of this pattern, we didn't get it, and this kind of looks to me like a failed breakdown. And failed breakdowns usually, but not always, there is a possibility of the opposite move occurring. So maybe this is a cup and handle pattern right there, and the height of this pattern is 6.2 some percent. And if we do get a breakout, maybe a close above 1113, we could easily get a move up to this resistance level, which is 6.2%, so 6.2% up. That's a possibility. Yeah. Is this going to be the bottom for gold? No idea. For now, I'm treating it as a bearish security still. If we do get about to this level, this could be an interesting position to take on a short side. But for now, next chart I'll show GDX, and it's kind of sending conflicting messages. as opposed to gold. So gold is certainly holding up better than GDX. And here is a structured technical rank for GLD, which ranks all non-inverse, non-leveraged funds against one another. And you can see it's actually above 90. So it's in the top 10% of funds right now. So that's something to consider. Long term, I still think gold is bearish, but maybe we're getting a bigger bounce. And clearly, so far, we failed to break down and to continue at 1,000. So let's next look at GDX and see where that one is going. Okay, this is GDX, Market Vectors Gold Miners ETF, our extremely choppy friend. Lots of gaps, you can see it's very choppy chart. It's quite an ugly chart if you ask me. There's lots of gaps, lots of choppiness around. In any case, we had a support break here this week with a close below even this low from September. We hit an all-time low. So it's very interesting because, like I just showed, gold is actually trading above this red line, the 50-day moving average, but GDX is way below it and hit all-time low. So kind of mixed messages here from gold and GDX. Clearly a bearish security again because all-time lows are quite bearish. But if gold does what I think it might do, which is rebound and continue higher to maybe what did I say, 1190 even, then certainly I don't see why GDX will not follow it higher and maybe at the very least reattempt to break above this $15 area, because looks like we failed here. Next, of course, failure to look for failure would be around here, and then around here. But in any case, it's one of those situations where I kind of just question myself: do I really want to be in this market? Because we have conflicting signs from underlying security and the miners for that security. So we'll see basically where it's going. Possibly we get a rebound, or maybe we can just collapse lower. Difficult to say. All right, now let's look at some of the charts I showed last week, and I pointed this one out. It's very interesting. It's XES, Oil and Gas Equipment Servicers ETF. We had a inverse cup and handle. Maybe this is a head and shoulders, but in any case, the height of the pattern was around 21%. We dropped to exactly that level on closing basis, spiked below it, but it's about correct. So I said that people, the traders might start covering their shorts here, and looks like they indeed have started to cover their shorts, and now we're getting a bounce. So that's one of the oil related ETFs I follow. Next one is XLE. This is the big one, the energy select sector SPDR. Here we had a inverse cup and handle with a possible head and shoulders pattern. Exactly 14.8% was duplicated on the downside. So interesting as well. I pointed out last week that we're quite oversold as measured by this bullish percent index. We were at 2.5%, so we were way oversold. Even for bearish security, this was quite oversold, and we got a bounce. Again, together with the general market, but this one really bounced pretty hard because next chart, I'll show oil. This is West Texas Intermediate light crude oil, end of day spot price. It was the same thing here. We had a measured move, 24.3%, and then we got it duplicated on the downside around that area. I pointed this one out. I said that we're getting very close to that measured move target, and some sort of a counter trend bounce is possible. And of course, looks like we got it. So far, we got, what is it, like 17% bounce off of the low here. If you're lucky enough to get in here, then you're, in very good shape. Here we had a similar counter trend rally, and this was about from a very bottom here in August till the very top here in October. We had a let me see, I think this was like 35%. So if we assume that this is going to happen again, we are about 17% up, so a 35% rally. Let me just do a inspect button again, excuse me. So from the low to the, so 35% would put us exactly at the broken support here. Now, I read some articles over the weekend, kind of like a really good in-depth fundamental analysis of oil, and the analyst was calling for oil to rebound probably to even as far as the $50. Now, it's pretty aggressive target, but it's not impossible. And look at this volume by price bars that I added in. We can see that this bar is sticking out here as pretty heavy volume resistance here. But the bigger resistance is in the 40s, and even in the very big one, of course, is in the mid 40s. So I think we might get some sort of a attempt to push the prices lower around 36, 37. Because of the broken support here that turns resistance, this 50-day moving average, and of course this volume by price. But I think maybe we'll even push higher to $42, $45 area. Now, if we do push higher here, maybe there'll something like this happen again. You can see that this price was rejected at the 200-day moving average. Maybe we'll get something like that as well. But in any case, this is a bearish security, clearly multi-year lows, and so far I'm treating this as a counter trend bounce. Incidentally, I wanted to show another chart of FCG versus natural gas related ETF that holds various natural gas related stocks. Same thing, you can see a measured move. This could be like some kind of a weird looking cup and handle maybe. Same thing, 24% on the downside. It did bounce, but it continued lower. So, those measured downside targets in clearly strongly bearish securities sometimes don't work out, and this move was actually a lot bigger. This was a 59% move. So, just something to keep in mind. All right, let's move on to natural gas. All right, this is natural gas spot price end of the daily chart again. Again, bearish security, multi-year lows here, counter trend rally from the lows that got as high as resistance from the peaks here. Now, we already got pushed down, quite well. This could be a rising wedge. If we do get a rising wedge break with a plunge lower, then almost certainly we're going to get a retest of this multi-year lows. I'm not really trying to pick bottoms. If you're lucky enough to find this, we're able to pick this bottom, then wonderful. But I'm not really trying to even look for them. I'm only interested in short setups, and this is certainly one of those bearish securities. So again, if we do break this wedge, it's kind of small wedge still. Maybe we get more trading kind of sideways and then plunge down, kind of like here we had a plunge, a trading in the wedge formation, and then a plunge down again, and then another wedge, another, you know what I'm saying? So it just kind of continues in this bursts, big plunge and then continuation of counter trend move. So I think this is a counter trend move, and maybe we'll get another plunge down and a retest of this multi-year lows. All right, that's all for natural gas. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of um, risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.